we actually took this process of going, all right, we're going to build a programming language. It's going to be completely new. And why does it need to be new? It needs to be new because the way you build smart contracts today is kind of insane. But you don't know that unless you're a smart contract developer. And if you're a smart contract developer, you know it's absolutely insane. And so we spent 2 years working with DeFi developers and Web3 developers, and we actually started building our programming language from the documentation backwards. We went, what does the perfect language look like from the point of view of the end user?
Hello, everyone. Welcome back to a Blockmates podcast. Today's guest is Piers from Radix, a layer 1 protocol that has been around for over 11 years now, and they've been diligently building something quite extraordinary, addressing the scalability problem, super fast speeds, an amazing community. And this interview was an interesting one because Piers and I actually just started speaking about market dynamics and what was happening in the crypto space in general. And the conversation just flowed so nicely that I just started recording. So when you do start watching, that's essentially what happens in this conversation. We just jump right in. And we cover a whole list of topics from real world assets, scalability within, protocols within L1s, L2s, where the market is at, where the market is going, what crypto has got to offer us and what the future of crypto holds. I really enjoyed this discussion and I hope that you guys enjoy it as well. Thanks for joining us. See you on the next show. Enjoy.
What happens in retail first goes into corporate second and goes into government third. And, when the first sort of crypto boom post Bitcoin was like, hey, we can create our own networks, right? And so people went off and created their own networks. And that's where you got like Dogecoin and Litecoin and stuff like that. And then about 4 years later, someone, Vitalik, came along and said, well, let's not build lots of networks that have specific functionality like Namecoin or whatever. Let's build a public ledger that has programmability. So, you can create any token you want, but it's all on the same ledger. And everyone in retail went, oh my God, that's amazing. When at the same time you're seeing corporates going, hey, what would be really cool if we ran our own network? And you got sort of R3 Corda and stuff like that. And then you saw sort of the emergence of DeFi so you saw the emergence of tokenization, and everyone was like, wow, we should have a token for everything. And then 4 years later, people were like, well, the thing that matters the most is liquidity. So what we need to do is create marketplaces for these tokens, and we should really focus on marketplaces. And that's when you got DeFi. And then corporates, which is sort of where they are right now, are like, we can tokenize everything and we should do it on public ledger. Forget this private ledger shit. Let's do it on public ledger. And, governments are now going, hey, what would be really cool if we ran our own network? And so what retail in crypto leads with, corporate follows 4 years later, and then institution, and then governments follow 4 years behind. So the sort of the cycle. And what I'm sort of looking at is going, well, 4 years ago was DeFi summer, and an increasing amount of capital is controlled by institutions in the crypto space, and increasing amount of the trade flow. So like trading crypto pairs, as well as sort of using crypto as collateral and things like this. And we're estimating it to be about 60 to 70% of assets held and flow in the crypto space is intermediated by people like market makers, people like hedge funds, people like fund managers, people like BlackRock, ETFs, all this kind of stuff. So what we're at now is this inflection point for DeFi to start taking a front seat, but this time for institutions. where institutions have now realized that building something on a public ledger, that's the way to go, because the benefit of building something on a public ledger is the instant interoperability that you have with all other things built on it, right? In a private ledger environment, if I want to clear to Goldman Sachs and I'm JP Morgan, I have to get JP Morgan and Goldman Sachs to agree on the ledger that they're going to, and like they're never going to do that. Coordination burden is too high, and they didn't, right? Like, so Goldman created their own thing, JP Morgan created their own thing, they sort of failed. But if you have a public ledger, a sort of a neutral ground for the creation of assets, you now have this ability to have any asset that you want clear to any counterparty, because they're sort of all integrated into the same infrastructure. And then the next level above that is, well, if I build a financial application, like a DeFi application for lend borrow, or a DeFi application for trading, and I issue, now corporations are starting to wake up, the smart ones are starting to wake up to this idea of, it's not just about tokenization, it's about liquidity of the tokens. Like, how do you make these things useful? Like, why would an institution want to hold a tokenized version of a fund versus just holding the underlying fund? And the answer is, if the token has greater utility than just the underlying fund. And that only comes when you have multiple marketplaces where you can use that tokenized version of the thing. Like, if I'm a hedge fund and I buy money market funds to park my cash, what's really useful is if I could use that as collateral. That kind of can already with prime brokerage and stuff like that, but they accept a relatively narrow range of assets, and they take quite a haircut. And institutions are also waking up to the fact that in crypto, counterparty risk is a real thing, right? FTX blow up, Celsius blow up, BlockFi blow up, 3 Arrows Capital blow up. Counterparty risk is it's the thing that all banks obsess about, and it's the thing that institutions are now like really waking up to the fact that, hey, I really need to worry about this when it comes to crypto, and where my crypto assets are, and who's holding my crypto assets, and what's my legal right to my crypto assets. And so they're now looking at DeFi and going, that's interesting, because what we're getting is this platform that anyone can come along and interact with, which means that I don't have to onboard, I don't have to be responsible for onboarding all the capital I might interact with, right? I don't have to onboard every single person. I've just got this like huge pool now of crypto capital that's just available, that's interested in opportunities. And I've suddenly got this ability to move these representative assets between different marketplaces. And so now institutions are now going, institutional DeFi looks really interesting. And there's two forms of this. Like, if you look at something like centralized exchanges, the thing that has been really interesting trend, and it's sort of very well established now, but like in the early days of centralized exchanges back in the day, you didn't have market makers. You just had like whales and people. Like, I can remember manually arbitraging between exchanges, right? The arbitrage was so slow that I could literally trade something in one direction on one exchange, send the crypto to another exchange, and then trade it the other way, and the arbitrage opportunity would still be there, right? Manually, like just via the GUI. But now every single crypto exchange, one of their most important counterparties is market makers. Every single trade that a retail person is making, and in many cases an institution is making on these centralized exchanges, is generally facing off against a market maker. And that's good. Like there's all of this, I have a lot of emotions about this, right? Like I got into the space believing in the power of disintermediation. And there are certain functions that within a market, they're actually really important to be provided by professional intermediaries such as market makers, because they are the ones that actually make sure that there's always liquidity available, because liquidity is choppy, generally speaking, and they smooth out liquidity. They make sure that you can always buy and sell into an asset. And so I'm looking at these trends. I'm going, okay, well, in the retail space on centralized venues, an increasing amount of retail is being facilitated by institutions. And in the institution to institution space, an increasing number of institutions are going, hey, this DeFi thing's really interesting. First of all, from the point of view of, can we access new markets, new capital? Because crypto is now a $2.3 trillion industry. Like, holy shit, that's a lot of capital. Secondly, are we able to make these tokenized versions of our existing products more useful and interesting as a result of tokenizing them by making them compatible with DeFi applications? And then thirdly, like, what kind of products, and this is just starting, like, I think that people are probably 4 years out from this, maybe. What kind of products can we now create from those DeFi Lego building blocks that only previously a bulge bracket bank could build? Like, as a tiny bespoke hedge fund or prop capital shop, I can now build like structured products using DeFi primitives that just I would not have been able to build as custom, because I wouldn't have access to all of the different marketplaces or liquidity that I needed to without privileged access to sort of like trading accounts and various bulge bracket banks, or being a bulge bracket bank myself if I want to make the market. And now DeFi enables that. And so for us, that's what we've been looking at. We've been going, this is the trend. This is where the market's going, right? Retail is going to be increasingly facilitated by institutional capital, and institutional capital is increasingly going to want to leverage DeFi for their own purposes, and it makes so much sense. That's where the money is, and that for me, it's not so much a pivot. Like, we're not going. We no longer care about user experience. We no longer care about developer experience. We no longer care about the retail user. That's not true. It's just that there is now this massive piece of the financial market starting to move into crypto, which ultimately will create greater opportunity for everyday people in access and their ability to be able to sort of invest, save, and do all of the things they want to. And the other thing is that, like, ultimately the best product, like the number one product for crypto, in my opinion, is a savings account. And like, why do I go to a bank and I get a 2% interest rate, and I can go into DeFi and I can lend out my stable coin and I can get like an 8% interest rate? And today that's real yield. That's real people who are paying that rate. And because it's permissionless, and because it's transparent, and because the rules are enforced by smart contracts, your counterparty risk is massively reduced. And so the risk basis, like, I think DeFi will be a less risky place to put your money than in a bank in a relatively short space of time, because a bank can fail, and DeFi is increasingly these really interesting, very resilient systems. But there's a bunch of problems with it, right? Like, this goes back to the fundamentals of Radix. Like, it's fundamentally insecure at a smart contract and an execution environment level. And that like, when you combine these things together, you go, look, you need a grown-up system that fundamentally can deal with hundreds of millions or billions of dollars securely, in a way that every layer of it is secure, and the way you interact with it is secure, and the way you program it is secure. And we need to make sure that we are enabling that capital to come into the crypto space and use these primitives that have been created, both for themselves and for facilitating retail. Like, it just all fits together for me.
It's interesting because we started out this discussion around tech and how important Piers and I feel it is.
Yeah.
But for some reason, we've had kind of like a scenario where Radix has delivered and over-delivered in many ways around technology that I believe is very necessary, and more importantly is very applicable for what is required in the context of DeFi, from security to deliverability to provisioning liquidity in the correct ways. I mean, the list goes on. I mean, for those of you who are wondering what Radix is, it's an L1. It's somewhat different in that it does things differently, but it delivers things in a similar way to what you understand DeFi to be. But more importantly, it's actually pretty seamless, and it started off as being like really good. I remember when we last chatted, it was kind of like, well, we're about to launch and there were a whole lot of things that needed to be taken care of. And that's obviously all happened. And it's been almost 2 years since then. And I think there's a lot that Radix has done that people just don't really acknowledge. And it's really weird, because that's how we started the conversation, is like, so where is Radix going and what is the perspective? And the answer follows from this introduction. And this is the longest intro I've done for anyone ever. So
No, I appreciate it. It's nice. It's really great to hear our story read back from your perspective. I think, you know, what we were saying before the call sort of is really interesting, in that I think the crypto space believes that it values technology, but I think that what it values most is narrative. And there's sort of like a big combination of luck and timing for the sort of like the technology narrative that you have to solve whatever is the sort of the main meta of crypto at the time. And, you know, a lot of those things require you to deliver things on that narrative quickly. The problem with delivering on narrative is that it often doesn't. The ones that come to market most quickly are often the ones that have taken the most shortcuts in how they do that. So, you know, Solana is certainly not the last platform that's claiming or is delivering sort of large scalability. But in delivering that large scalability, they took a bunch of shortcuts in how their smart contracts worked, in how their execution environment worked, and to some extent in how their consensus worked. And a lot of what Solana's had to do, and like I think Anatoly is great, and I think that the Solana community is amazing, and I think that the platform has done incredible things. I'm certainly not throwing rocks at, from the point of view of going, these guys are crap. But I think that they launched a product right at the time when that narrative was about scalability being a problem for Ethereum, right at the time when it was becoming a problem again. Like, interestingly, that happened twice. So first of all, it happened when CryptoKitties caused the Ethereum ecosystem to sort of grind to a halt, the Ethereum network to grind to a halt. And that, like, the really big play there was EOS on that narrative. But EOS, for lots of reasons, took a lot of shortcuts in a lot of different ways, right? But, you know, they raised a huge amount of money and then failed to deliver on their promises. And then with Solana, like, they delivered a product, but the product was broken in a lot of ways, and they've had to sort of fix it on an ongoing basis. And I think that there's a problem that is really difficult for just your average crypto enthusiasts to sort of really grasp, which is that, and I talk about this from time to time, shipping a public layer 1 is like shipping hardware. It's not like shipping software, right? Like, once you have fixed your state management system, once you have fixed how your execution environment works, once you've fixed how your smart contract programming language works, it's really difficult, like really difficult to change things. Like Ethereum is massively struggling with this and has been for ever since they launched, basically.
Yeah.
And Solana the same. And I think that on a short-term perspective, you can go, well, they launched, they got the money, they got the ecosystem, they'll work it out. I think that that's actually probably not true. And the reason that it's probably not true is that the decisions that you make on the drawing board for a layer 1 protocol live with you essentially forever once you've shipped it. And you have to sort of tie yourself in increasingly complex knots, like you're seeing with Ethereum, with the layer 2s, and sort of the various narratives around rollups, the issues that's causing with liquidity fragmentation, the issues that's causing with sort of drawing attention away from the layer 1 protocol itself, the likelihood that some of these L2s will actually split off and become their own L1s is relatively significant. And I think that you're seeing this mistake being made again and again, but it's because the market rewards speed and narrative alignment rather than sort of really well thought through engineering approaches to problems in the short term. Obviously, the Radix view is that in the long term, that's what the differentiator is. That's what means that you can constantly be better than someone else because you have a system that has been well thought through from the start.
So just coming back to the fundamentals of this thing, and I completely agree with you. I mean, and we've seen it; it's out in the wild. Like you really do kind of like once you launch this thing, you kind of you are carrying whatever whatever extra load there is, you're going to carry it with you until you can find a solution. And generally, there just isn't one. And I completely agree with that sentiment. I think it's very evident in obviously the cases that you've demonstrated. And I think what's interesting for me around Solana is that Solana really has managed to almost bypass, for now anyways, these problems that are inherently there. And I don't pretend to know what those are, but I'm pretty sure they are in light of the issues that we've seen in the past. But they've managed to strike whilst the iron was hot around, obviously, this meme coin culture and the ability to be able to deliver on that. And kudos to them. And I think everyone will take their hats off, irrespective of what you feel around meme coins.
100%.
But yeah, and I think for me, the question that I want to ask you is that, so we have this amazing piece of technology and all its complexity that took you guys literally a decade to build this thing. And for those of you who don't understand, it's kind of like, like you hear about an L1 that's launching and it launches 6 months later or a year later. I can guarantee you, based on the information that I have sifted through over the last 5 years in this space, when someone does that over that period of time, there are going to be problems. Whether you see them today or tomorrow or in 3 months' time, you will see some kind of problem around that. So, but that's a conversation for another time. So here we have Radix. Radix has taken a decade to build, plus a couple of years here and there.
Right.
And let's assume that it is perfect. Let's just assume, which I know it isn't, but at the same time, let's just assume that it is, and it does what it says on the box, and the list is long, and there it is. There's the box, and it's kind of like, the question that I have is, what do you think are the ingredients that are required, irrespective of whether Radix has managed to kind of like achieve that success? But what are those ingredients that are required in order to find success in the space? And let's assume that success is lots of volume, lots of activity, lots of developers coming in and out, lots of customers. So we've defined success. What do you think you guys have to do and are doing in order to achieve that? I know it's a big question, but I'm
What do
really
we have
curious.
to do, or what? Like, I mean, I can give you.
Well, what do you
I
have
can
to
give
do?
you. I can give. I can give the ingredients
Yes,
that
that's what I want. Yeah,
are the easiest path
yeah.
to that. I think that they are, for lots of reasons, and partly because of how old the Radix project is, were things that we were not able to do. But I mean, from a pure marketing point of view, you have two products at base if you're building a layer 1 or a layer 2, or indeed a DApp. You have the token, which is a product, and you have the platform, which is a product. And I think that the most successful people in the crypto space start with the token as the product first, and then define the platform sort of as part of that. And when I say the token as a product, then it's thinking very carefully about how you launch the token. It's thinking very carefully about who your initial investors are. It's thinking very carefully about basically what are the checkpoints for the narrative that you're going to be supporting, that starts with this like fundamental belief in this token is going to be more valuable tomorrow than it is today. And there's lots of check marks along the way that if you can tick them, you are in a very good place to be able to raise capital. And then the other thing that's really important is this timing aspect of, like, you have hit on something that is unique enough as a technology offering that also hits a core narrative that the crypto space either does care about or can be made to care about. So good examples of this is things like Celestia and the modular blockchain thesis. Good examples of this are things like Pump.fun, who realized that there was this sort of intrinsic problem, like difficulty, complexity, for launching a meme coin in terms of like establishing the pre-sale and making sure there was secondary market liquidity. It wasn't just the pre-sale, but it was the liquidity point and like all of this kind of stuff. And so I think that token first as a product, platform second, and then some core narrative around what your platform does that is hitting the meta at the right time, or is able to construct a narrative around that meta that's differentiated. What is Radix doing is a fundamentally sort of like different question, because our token has been in the market for a very long time. Our platform has been around for a very long time. And so our narrative of what we're doing hasn't shifted because the fundamentals don't change. Like, if you're building a layer 1 protocol, you fundamentally want it to be as scalable as possible. You want it to be as secure as possible. You want it to be as easy to use for developers as possible. You want it to be as easy to use for end users as possible. And those narratives, those narratives that are around the platform, are things that you sort of continually see echoes of within the crypto space. But we've had to build every layer of the stack. So, like, to understand Radix, you kind of got to peel back the layers. You got, oh, it's a new way of interacting as a user. Oh, it's a new way of building as a developer. Oh, it's a new way of executing and ensuring security. Oh, it's a new way of building consensus. Like, holy crap, that's a lot. I have to understand a lot, and I have to believe that all of those things work together in the way you say that you do, because I, as a layperson or someone who's just interested in the crypto space, I can't assess that. Right? It's very difficult for me to assess that. So the only way that we really can make sure that continually rings true is demonstration of things being built on the platform that fundamentally are better as a result of being built on Radix. And so that's what we focus on.
And I think you guys have done a great job from that perspective. Now it's like, like, how do you then approach the market from that perspective? Is it a process of education? Is it just a process of marketing? Is it about, kind of like buying Ferraris and dancing girls and kind of like because we saw that, right? It's a token 2049. I mean, it's kind of like, does that shit work? Like, maybe it does, but is it really like a case of just keep doing the right things, and then there's just a matter of time before you do have
I don't believe in the sort of build it and they will come philosophy.
Yes.
Like,
Okay.
I think that you have to work out what your focus point is, and build from there. So like, one of my friends always says that you don't light a fire by taking your lighter and running it across all of the pieces of wood. You hold it on a piece of wood until it catches light. And often business books talk about this as like establishing a beachhead or whatever, right? And critically, if you're looking at the sort of the Peter Thiel 0 to 1 view on this, you're looking for the massive unopened door that people aren't yet going through, rather than the crowded, sort of corridor that everyone's trying to push their way through. And so the Radix philosophy on this has been, first we had to deliver the network, right? And you said it's been live for 2 years. It's actually only been live for 1 year. It was 1 year anniversary, like 3 days ago, right?
Yes.
So Babylon, which is when when the full stack went live, when sort of the Radix wallet, Scripto, the Radix engine, Cerberus, all of that stuff that we've been working for such a long time on, when that went live. And so we really started as a grassroots movement, like to be able to establish a community around a new programming language. You have to do a huge amount of work to get that up and running. And with Scripto, I am super proud of what we did and how we did it. We actually took this process of going, all right, we're going to build a programming language. It's going to be completely new. And why does it need to be new? It needs to be new because the way you build smart contracts today is kind of insane. But you don't know that unless you're a smart contract developer. And if you're a smart contract developer, you know it's absolutely insane. And so we spent 2 years working with DeFi developers and Web3 developers, and we actually started building our programming language from the documentation backwards. We went, what does the perfect language look like from the point of view of the end user? And then we worked backwards from there until we got to the point of what Scripto was, and we were getting this incredible developer feedback, and we built a grassroots movement from that. So we had to build all of this fundamental tech, and we had to get the network up and running, and we had to sort of get our core community sort of participating in the ecosystem and all this kind of stuff. And then you've got all of these sort of challenges that you have intrinsically as a different stack to someone who's just forked the EVM, in that it's really hard to get trustless bridging, or at least trustless bridging that I would trust. And we've been working with Layer 0 for a pretty long time now, and it's still not live on the Radix network. And so and you look at custody took ages. You look at exchange integrations, that takes ages. Like all of these things that are like the pieces that have to be in place. So all of that foundational stuff just had to be right. So we've got our up and running network. It's super solid. We haven't had any problems with security. We haven't had any problems with the underlying code. Like, it's all working exactly how we wanted it to. Every single auditor that has taken a look at our stack has come away raving, like, oh my God, this is amazing. This is amazing. Like everything that you have done, like with our public audit with Hacken, we got 10 out of 10 across the board. Security 10, documentation 10, architecture 10. Code quality 10. Like people are going like, this is phenomenal. So now you have to go, okay, well then what's your beachhead? How do you work out what that huge door that people aren't going through yet is, rather than the crowded door that everyone's going through? And this goes to this idea of You focus where the money is going to be coming from rather than where it's already coming from. And that's our fundamental thesis.
So where do you believe the money is going to come from? And I suppose this leads on to where we started.
Yes, exactly. That was my segue into my answer. Yes, exactly. That was my segue into my answer they gave at the top. Exactly.
So let's just recap that quickly. And then I think the question for me is like, how are you guys approaching kind of like that institutional, more kind of focused attention?
Yeah. So like you start, I mean, like any good product development process, you start with a anchor customer, right? And you go, what are the big problems? What is a set of big problems that a actual institution has? And we can go and sit down with that institution, and it's a big enough problem that they're like, we will work with you. We'll give you our time, we'll give you our resources, we'll give you developers, we'll let you talk with our senior management. We will work with you to create a product to make this work for us, right? And the first thing that we realized was essential for DeFi to be successful and for institutional capital to be successful on top of public ledgers was the problem of liquidity. Like, AMMs are a freaking great invention from the point of view of bootstrapping a small community token into something interesting. But after they've established themselves, the majority of the trading volume ends up going on centralized exchanges. And the reason for that is that AMMs are super capital inefficient. They have a bunch of issues around impermanent loss. They have a bunch of issues like a market maker expects to be able to take on and put off trades multiple times a second. Like, and you can't do that on a public on a public network via an AMM. You just can't get that. You would you either completely stall the blockchain because you're creating congestion, or you're just going to burn fees, right? And when you're making, like, when you're a market maker and you're trading something like BTC versus USDC, and you're making like 2 basis points a trade, and you're trading, a $50 million clip, like, the cents matter because you're operating at volume, right? And so we realized that the problem in the DeFi space we're constantly seeing is this: that liquidity is sort of melts out of DeFi once a token reaches a certain level, and you have this massively fragmented liquidity ecosystem, right? Like, so if you look at if you want to go and trade ETH-based assets, go do it on ETH. If you want to go trade Solana-based assets, go do it on Solana. If you want to access Solana, sort of, if you want to be able to use those tokens as collateral that are from Solana, you got to go to Solana, right? But then you look at the user base of DeFi, and it's like 5 million users. Sounds like a lot. The user base of centralized exchanges is 420 million users. And so there's this massive differential between the two. And part of it is liquidity. And part of that is because it's really hard to facilitate sophisticated liquidity on the existing DeFi AMM model. And the second problem is this fractured liquidity. Like, I just want to trade the coin. Like, I just want to trade the top 20. I just want to trade the top 10. I want to trade the top whatever. There is no DeFi venue that I can go and do that with at spot. Derivatives are a different thing. Derivatives are really interesting, but at spot, Like, forget about it. You're going to be going to some places for some things and some places to another things. And I'll just open Coinbase, right? Yeah, I've got a KYC, but I can just access everything.
Have you tried a KYC with Coinbase?
Yeah.
It's an impossible process. I've tried.
No, I got like, so I went through my KYC and my AML, and then I was like, I basically did. I traded well away. I traded well on one exchange, moved the money to another exchange, and then my account got flagged because they were like, "Well, you're over your, AML limit," because I didn't want to disclose everything. I was just like, I just gave them my, pay stubs or whatever, and just went through this like absolute, the most painful experience I've ever gone through. I've just been like, I want my money back.
I've also experienced that, and I landed up just closing it. I literally closed it.
Right.
So
And
anyway, so I generally just don't use central exchanges.
But for the average person,
Mm.
like for the average person, that is fine. I have to do it for everything else, right? So there's this ground that DeFi is fundamentally losing by dint of not being able to have great liquidity that is not fragmented. And so we realize, and that's the fundamental building block. Like I was talking about, like, what do institutions care about? Institutions are now caring about not just the tokenization of things, but the secondary market liquidity of things. And they're also caring about the utility of the token within, sort of being able to use it for something else, so that you're being able to use it for collateral, right? And so to be able to do anything in DeFi, you have to start off by going, what are the assets that I can use within my DeFi ecosystem? And then what's the liquidity base of those assets, so that if I need to do something such as a liquidation, I can actually do that. So our starting point was, okay, institutional capital is coming. That means that they're moving at size. And if they're moving at size, you can't be going, well, this has got to be, you can do $1 or $2 million liquidations. You got to do $100 million liquidation. Like, how do you do that? And so we started with this project that was called, initially we just called it Flash Liquidity. It's now, a product called Anthic. And we were like, well, can we solve these two problems at the same time? Can we solve fractured liquidity, and can we solve the liquidity itself of any asset on top of a public ledger? And so what we'd done with Anthic is we did a couple of things. The first thing was, we want to make it so that you can trade any asset in the top 50, then any asset in the top 100, then any asset in the top 200 at the same liquidity that you can trade it on a centralized exchange. And we want it so that you can do it as a market maker at the same level of granularity that I expect to be able to do against a centralized exchange. I expect to be able to update my pricing every, sort of like 10th of a second. And to do this, we had to invent a bunch of things that have all been in the works over a very long period of time, but are all now just starting to come together. Like on Radix, we built intent-based systems into our protocol. Like the transaction manifest as a programmable layer for transactions on top of that sits over the top of the smart contract layer on Radix. So you can program into your transaction your intents and your invariances. You can say, I'm going to swap this token for this token, but if you return me less than this, then I want it to fail, right? So you can basically, in the transaction already, you can declare what your intent is. I want to trade this for this, and if it doesn't succeed, if I don't get this back, I want it to fail. So we then had to, it was a relatively simple aspect of then going, well, how do you make that intent something that you can send offline that can then be enforced on Ledger at some point later? So now you can have an entirely trustless off-ledger system where you can, for free, put on and take off orders like as many times a second as you want. As a market maker, that's great. Suddenly,
Yeah.
I've got the granularity to be able to express my pricing, and I can do that for free, but it will still be executed on top of a public ledger in a trustless, decentralized way. Great, right? And then the second problem was, well, how do you map the liquidity of these assets? So how do you represent these assets, and how do you map the liquidity? And this is where it got quite interesting with something that we built a long time ago. So we built this trustless bridging system. Trustless bridging system. We built this compliant bridging system called InstaBridge. Actually, a sort of a spin out of RDX Works, which is the company I'm the CEO of. And we initially built it as the first sort of like bridging protocol between Ethereum and the Radix network. And we built it in the way that we did because we were like, we could either build a trustless bridging solution, but that means that we also have to maintain a trustless bridging solution ourselves if we build it ourselves. And if you look at like Near with the Rainbow Bridge, and if you look at a bunch of other sort of like systems, that's actually quite problematic when you want to, as there are a million other ecosystems that are constantly launching, you've just got to constantly add them. Whereas you can work with a fantastic existing trustless bridging solution, but it's not going to be live when your network goes live. Okay, so then if we're going to have to build a bridging solution, how do we future back it? Okay, well, institutional capital is going to be really important in crypto. So institutional capital isn't going to be wanting to interact with trustless bridges. They're going to be wanting to interact with a counterparty because of lots of reasons, regulation, all this kind of stuff. So let's build a compliant bridging solution that allows us to create representations of any asset on top of the Radix network. And when I say any asset, I actually do mean any asset, right? It can create representations of crypto assets, but it also has the feasibility to add representations of any asset that exists in the world on top of the Radix network. And then let's add this extra concept to it, which allows a market maker to express a intent to trade without already having the assets on the Radix network. So now what they can do is they can mirror the liquidity on their centralized venues onto the Radix network. So you want BTC versus USDC on Anthic, or now you will be able to, when it goes live, you can trade that at the same level of liquidity, slippage, and pricing you're getting on Coinbase. Why? Because the market maker is literally mirroring the liquidity that is on Coinbase on Radix, and no bootstrapping was required. Now this becomes really interesting just for the crypto market. Now you don't have fragmented liquidity. I can come to Anthic. I can trade the top 50 tokens. I can trade the top 100 tokens. I top 200 tokens. Those will be rolling out in order. But then for institutions, that starts to become really interesting as well. Like, my money market fund is liquid on a market. Does that mean that I can map the liquidity of that secondary market into the Radix network? Absolutely. Now you've got some fundamental building blocks. Now you can do some really interesting stuff because you've solved one of the big issues, which is secondary market liquidity of tokenized objects currently doesn't work very well because you have to bootstrap the liquidity. Even if there's a liquid secondary market somewhere, you have to bootstrap that liquidity on ledger into AMMs, which is just not really suitable for capital of this scale. So that's the first thing that we built. But it's all part of this sort of strategy of going, where's the money coming from? Where's real money coming into the crypto space actually going to be moving, and how they're going to be moving? What are the key things that they need? And it's just a continuation of this fundamentals approach. But now we're building the products that are necessary as well, where we have built up these relationships with these institutions where we can have these conversations and really start to hone in on the things that are necessary to make institutional DeFi, either facilitating retail or institution to institution, actually work on a public ledger. And we have so many advantages in doing that.
So, I mean, obviously the biggest challenge from my perspective here is is kind of like the domino effect, right? So you get, say, JP Morgan comes in and they're like, okay, cool, we like from a business development perspective, it ticks all the boxes. You guys build it, and it's kind of like, okay, well, it does what they want it to do, and it's solving all these problems, but then you still only have the one client. How do you create that domino effect? Is it a case of getting the one across the line? Is it really that, or is it multiple deals running concurrently and bringing them all together? What is the strategy from the BD side of things, like when it comes down to the brass tacks of this stuff?
Yeah, no, it's multiple deals running them together for sure, because ultimately DeFi is a marketplace.
Yeah.
And so, when we designed Anthic, we didn't go and talk or partner with one market maker. We publicly partnered with 3, and spoken with a lot more. And you have to make sure that there's this like sort of you have in there's this wonderful video that's so stupid, which is about sort of how crowds move, and it's just a study of what are the impetuses to make people move into something. It's actually not the first mover, it's the second mover. So like someone dancing on their own is a weirdo, but someone joins them, now it's starting to become a dance, and that's when you start to see other people come in and join. And so it's a similar exercise, but like the nice thing about these kind of products is that you in institutional finance, you have buy side and sell side already. You have people who have matching and opposite needs, and a lot of the time they are underserved or completely unserved within the DeFi space, but are very interested in all of the advantages that DeFi offers them. So reduction in counterparty risk, the ability to aggregate liquidity, the ability to have full transparency in sort of positions, the ability for things to be automated and intermediated by smart contracts rather than humans, like the non-custodial nature of it, all of this kind of stuff. Like you're talking their language already.
Yeah.
And now you add to this facilitation of going, well, I've got these 2 people, I got these 3 people, I got these 4 people, I got these 5 people, bring them together, and suddenly you can start to make magic happen. Now, obviously, I'm talking about things that are not yet public. Like we've started the process of this, and so Anthic is the first thing that we've got out publicly, but it's just one of the building blocks that sort of makes this all come together.
So it is almost like you guys are doing, like, it's like a dual highway. It's kind of like, well, we recognize the role that retail has to play in this, and you've always been very considerate around that. I mean, I know that you guys had quite a big push in terms of the wallet that you guys have developed,
Yeah.
which was always like, I remember when we chatted, it was kind of like, well, we've got to make that an easy process, and I think it is an easy process now. It's like,
Yeah.
yeah. So you guys ticked that box and was like, okay, well, and obviously it's going to serve you in terms of how you roll this thing out from an institutional
Yeah.
perspective. So you guys did that, and then there was obviously kind of like this whole move around the awareness of DeFi and how it can obviously best serve functionality around lending, borrowing, whatever the case might be. And there's obviously a real sense of community that is there. But now the big challenge now is how do you kind of like increase that by a factor of 10? And it comes back to the question that I'd originally asked you, is that it's kind of like, is it a case of incentivizing? Is it a case of presenting a solution to a problem that exists? Or do you think it's something more beyond that?
No, it's definitely a case of incentivizing. I think, sort of like our experience with the Radix wallet is sort of very indicative of that. What was really interesting about the difference between the Radix wallet and the and Scripto programming language was, with Scripto, in building our sort of like initial ecosystem of developers, it was addressing a real problem that people came across every single day in what they were doing, and it was absolutely terrifying. And it was something that they were having to touch every day, and it was something that they are having to manage real money with, right? Like if you're building Solidity smart contracts, like the terror of deploying a DeFi protocol built in Solidity, like it's really hard to communicate to someone who hasn't been like, oh shit, like I got one tiny line of code wrong and like literally everything could disappear and I could get a call tomorrow saying it's all gone. And so that pain threshold was super high. When we were building the Radix wallet, our goal was to make it easy enough for everyday people to be able to use Web3 and crypto. The truth is that everyday people don't yet want to use Web3 and crypto. The majority of the Web3 and crypto users are here as sort of, there's several profiles, but like mostly very well-informed technical people who kind of will happily go through a bit of pain because they're not here because they want to use something fun. Ultimately, they're here because they are like, hey, the fun thing for me is the gamble. The fun thing for me is the like beating the market. The fun thing for me is being part of a community. And like, yeah, I might get hacked on MetaMask, but like my risk profile is like sort of very, very far to the north of most everyday people's. And so we built a product that, while solves the problem for everyday people, it doesn't solve the problem that everyday people don't yet want to use crypto and Web3. So I think that we are sort of very much now of the opinion that the main thing that you need to do to make people care is you've got to work out what the dopamine rush, the crypto aligned dopamine rush is. And it's around incentivization, it's around gamification, and it's around like sort of the meta of crypto. And so all of those things matter when you're building something like Anthic. You know, like there's, as I say, there's the two products. There's the token and there's the platform, and you have to treat them both like you have to make sure they're both aligned with the people that actually matter for that. And so incentives still matter hugely in crypto. Crypto is built on incentives. Like Bitcoin wouldn't work without the economic incentives. Ethereum wouldn't work without the economic incentives and punishment. And like sort of most crypto people have kind of been wired in that way. Like, what's in it for me? Why am I doing this? What's my incentive? So yeah, absolutely. It's not just building a great product. You got to build everything else as well.
So what incentives have you guys been kind of like, I suppose this is probably the only opportunity that I've given you to do some sales talk. So go for it.
Yeah. So I mean, like, Anthic is not yet live,
Okay.
and so and we haven't announced when it's going to go live, and we haven't yet announced anything around sort of any of the incentivization programs or anything like that for it. What we have done though in the past is we've run sort of various experiments, like when yield farming was a thing back in sort of 2020, 2021. We did, a very successful yield farming campaign for the EXRD. Earlier this year, we did a liquidity incentive program called Project Ignition, which I think jumped our TVL. I think it quadrupled our TVL, like within the space of a week. And since then we've done like super staking, which was another incentivization campaign that we worked with some of the ecosystem projects in our to get live, and that sold out I think within like 5 minutes or something like that. So we've been running experiments, and I think that I'm pretty excited to talk about all the stuff when it's ready to go live, but it's not ready yet. So like the main thing I can tell you about is like the theory and the strategy, but in terms of the actual go to market, there's a couple more things to get sorted.
So the question that I'm dying to ask you is like, what lessons did you learn in that process from those experiments? What were the most valuable kind of like insights that you had from that process in terms of
Yeah,
human behavior, in terms of like what people were looking for? I mean, yeah,
yeah.
I'm curious, really
I think
curious.
that I think the core of it is you can always pay people. You can always pay if you pay people enough. You can always get them to come somewhere.
Yeah,
The trick of a great incentive program is making the thing that they're coming to do interesting enough for them to keep coming back. And sort of yield farming was very much the sort of like mercenary meta of crypto. And I think sort of our liquidity incentive program was much more about establishing base level liquidity within the Radix ecosystem, and sort of achieve that target, but didn't move from there because the projects that were live when the liquidity program went live were not quite mature enough. Like the network had recently launched. There was people had just built their first DApp on the Radix platform, and there wasn't enough of that like sort of hook to be there. I think that's changing in the Radix ecosystem. Actually, particularly this month, you're going to see the launch of Surge.trade, which is a perpetuals DEX, sort of in the style of GMX, built by a super strong team that I'm super excited about. Like their beta net has been amazing. You've got Trove Pro, which is essentially like a Blur like NFT pro trading platform, which I'm actually super bullish on for a couple of reasons. Like the first is like NFTs are interesting as a meta, but I actually think that NFTs are going to be super important for financial products as well, because most financial products aren't actually fungible. Like most financial products are custom in some way, and probably NFT representation is more likely than fungible tokens. So like making sure that you've got the Bloomberg terminal to trade bonds is to me pretty exciting, and I think that the guys who have built Trove have done a fantastic job of like making sure it can do both, like extensible enough to great from the point of view of the DGen NFT trader, but also extensible enough to be able to sort of like spread into sort of some really interesting serious products as well. And there's obviously Anthic coming, and so like now we're getting to the point where you're like, we've got an incredible wallet experience. You've got this incredibly secure layer one protocol that has just basically been running fantastically since it went live. And you're starting to get these applications that sort of appeal to the crypto meta. They're actually like interesting enough that I want to come back to this every day or every week. And then you add this idea of, hey, now I can trade what I would normally be trading on Coinbase or Binance, but in a non-custodial, decentralized way via a fantastic Web3 wallet that just feels so natural and so easy. And you throw in some incentives in there, yeah, that starts to get pretty interesting.
so I mean, something that we didn't touch on, and I suppose it's kind of like, maybe it's a verse that you've sung so many times, but I'll ask the question: how many security issues, hacks have you guys seen on the Radix network?
Yeah, it's a good question. I think there are sort of like two levels. There's actually three levels that I care about. So level one is hacks at the sort of execution or consensus level, right? something like fundamentally wrong with the implementation of the execution environment, like like was seen during Ethereum DevCon 2, where someone was able to arbitrarily take down the entire network because they had sort of like decompiled the bytecode of the EVM and worked out a way of basically for free completely stopping the network. And the level sort of 2 is your mistakes in code execution. And actually, there's two parts to this. In Radix, there's the Radix engine, right, which enshrines a bunch of primitives. So, like, instead of having to define a token in a smart contract, you just call the parameters for the token that you want to have created, and it becomes a native object of the Radix network, or accounts, or your authorization stack. Again, nothing, no hacks, nothing even close to it there. Then above that, you've got errors in business logic. So Scripto is very good at giving you guardrails. It's very good at going, if it doesn't compile, you've done something like wrong with how you're handling tokens or how you're handling something to do with the enshrined objects. And so for like when your Scripto code compiles, that you're like 95% of the way there. But what we can't guard against is people making business logic errors, like just going, like incorrect maths, like on how something interacts with. And at that level, we've had one, which one major one, which was a project called Gable Finance, and there was a Lend Borrow platform, and they had made some business level logic mistakes, and we can't, you fundamentally can't guard against that on any platform. If you program your business logic about, if it tells me that I can put in one token and take out two tokens, and the two tokens are worth twice as much as the one token, it will do that all day every day, because it's a logic in your business logic. It's an error in your business logic. And then at the user level, from the point of view of the kind of things that you see in Ethereum, so signature manipulation attacks, things like infinite approver permissions on tokens. So the example that people keep doing, which is they sign something in MetaMask, they don't know what they're signing. It turns out that they're giving approval on all of their tokens, and suddenly all of their tokens have disappeared from their wallet. So user level exploits, again, none. Just hasn't happened on Radix.
And for me, that's the number one reason why I think Radix is superior. I mean, I know that there's the technical aspect and the way that the smart contract within the Radix ecosystem works. And for me, that's what boggles my mind, is like, if you can get the same delivery of whatever it might be in the DeFi context, why the hell? It's really, that for me is the big question mark. I mean, we've obviously chatted about it extensively, and I think for me, it's like, for anyone who is listening and who has been following this conversation, and you don't know what Radix is, or if you are curious about Radix, go to the Blockmates website, go and do a search for Radix. We've written extensively about Radix since the early days. I think the first time we wrote an article about Radix was 3 years ago. It's still one of those articles that people always go back to, even though it's out of date. We just updated the article.
Nice.
With something that we did it 2 weeks ago, I think. That's why we've got you on, because we kind of like doing a rehash.
Yeah, I saw it. The full stack for was it the full stack for Web3 or the full stack for DeFi you had on your website just recently?
Yeah. So for those of you who are curious, go check it out. I mean, we don't really kind of like, we're just here to comment about what people are doing, and we like to think that we generally commentate on the stuff that's worthy in DeFi. Not all of it works. Some of it doesn't. Seen a lot of really great projects not, reach their full potential for whatever reason, funding, bear markets. But we always seem to come back to Radix and yeah, I think, it's been cool to check in with you again, Piers. I mean, you guys, we're big fans, and we definitely wish you all the best in terms of what you guys are doing. And I mean, Dan has always been a great friend, and he always comes on at the drop of a hat. And it's always a pleasure. Thanks so much for joining us and sharing.
Thank you so much for such a great interview. Like, it's always such fun to talk to you. You always ask such thoughtful questions, and you always give so much space to answer, which I appreciate.
Thank you very much. Yeah, it means a lot. I think for us, we love what we do, and we love when we see you guys kicking ass, and it's like, please keep doing it so that we can keep having these discussions. And it's been an absolute pleasure, and I really appreciate the words and your time. Thank you.
Thank you so much. And
Cool.
if you want me back at any point, just ping me. Very happy to.
Damn right we will. Thanks everyone for listening in. Please like, subscribe, go read the articles, go check in what these guys are doing. I promise you won't be let down. There's some really cool stuff happening. Take it easy, and we'll connect next time. All the best.
Nothing here is financial advice. It's for entertainment and educational purposes only. Always do your own research or speak to a financial advisor before making any investment decisions.